Hello everyone and welcome back to our deep dive into Benjamin Graham's classic book, The Intelligent Investor. Today we're going to be discussing Chapter 4, A Century of Stock Market History. This chapter provides a comprehensive look at the history of the stock market over the past 100 years, and the lessons that can be learned from it. Let's get started. Part 1, Understanding Market Trends. The first thing Graham does in this chapter is to provide an overview of the stock market's performance over the past century. He starts by discussing the long-term upward trend of the market, emphasizing that while there have been periods of decline, the market has historically trended upward over time. Graham then highlights some of the major events that have impacted the stock market, such as wars and recessions. He shows how these events have caused temporary downturns in the market, but that over time, the market has recovered and continued to trend upward. The purpose of this overview is to highlight the importance of understanding market trends when making investment decisions. By understanding the market's historical performance, investors can make more informed decisions about when to buy and sell. Graham goes on to emphasize that it's crucial for investors to understand that the stock market is not a static entity, but one that is constantly changing and evolving. As such, it's essential for investors to stay informed and up-to-date on current market trends and conditions. Conclusion: understanding market trends is an essential part of becoming a successful and intelligent investor. By having a comprehensive understanding of the stock market's history and performance, you'll be able to make informed investment decisions and potentially avoid costly mistakes. Okay, now, before we continue, don't miss out on the latest investment tips and insights. Make sure to hit that subscribe button now and join our community of intelligent investors. You'll be the first to know when we release new videos, and you'll also have the opportunity to share your thoughts and opinions in the comments. So what are you waiting for? Click the subscribe button and let's start learning together. Part 2, The Importance of Diversification. In Part 2 of this chapter, Graham explains the importance of diversifying one's investments. He argues that by investing in a variety of different stocks and industries, an investor can reduce their overall risk and potentially increase their returns. Graham cites several historical examples to support his argument. For example, he shows how investors who diversified their portfolios during the Great Depression performed significantly better than those who invested heavily in just one or two stocks. The author also emphasizes the importance of avoiding market speculation, instead encouraging investors to invest in a diversified portfolio of blue-chip stocks. Blue-chip stocks are those that are well established, have a strong track record, and are likely to continue performing well in the future. Graham stresses the importance of maintaining a well-diversified portfolio even during periods of market uncertainty, as this can help to reduce the impact of any one particular stock's decline. Conclusion: in conclusion, Graham's message in this chapter is clear. Diversification is crucial for reducing risk and increasing potential returns. By investing in a variety of different stocks and industries, investors can help to mitigate the impact of any one particular stock's decline. Part 3, The Role of Emotion in Investing. In Part 3 of this chapter, Graham discusses the impact that emotions can have on investing. He argues that emotions such as fear, greed, and hope can often lead to poor investment decisions, as investors may make impulsive or irrational choices based on their emotional state. Graham cites several examples of how emotional responses to market events can lead to disastrous results, such as investors selling off stocks during a market downturn and missing out on potential gains. He also notes that emotions can cause investors to hold on to losing investments for too long, instead of cutting their losses and moving on to more promising opportunities. To counteract the impact of emotions in investing, Graham emphasizes the importance of developing a systematic approach to investing. This means having a well-thought-out investment strategy and sticking to it, even during periods of market volatility. He also encourages investors to avoid making investment decisions based solely on short-term market trends, instead opting for a long-term perspective. Conclusion: in conclusion, Graham's message in this chapter is clear. Emotions can have a major impact on investing and must be considered when making investment decisions. By developing a systematic approach and avoiding impulsive or emotional decisions, investors can help to mitigate the impact of emotions on their portfolios. Here are some practical tips based on the conclusions from this chapter. Monitor market trends. Regularly monitor market trends, such as the S&P 500, NASDAQ, or Dow Jones, to get a better understanding of the overall market performance. Diversify your portfolio. Diversify your investments by investing in a variety of different stocks, bonds, or other securities. This will help to spread out risk and reduce the impact of market downturns. Avoid emotional decisions. Avoid impulsive decisions based on fear, greed, or hope. Have a well-thought-out investment strategy and stick to it, even during periods of market volatility. Focus on long-term goals. Focus on your long-term financial goals, rather than short-term market trends. This will help you to avoid making impulsive decisions based on short-term market performance. Do your research. Do your research before making any investment decisions. Read up on the companies you're interested in investing in and be sure to understand their financials, products, and overall business strategy. Be patient, and don't react to short-term market fluctuations. Instead, focus on your long-term goals and stick to your investment strategy. By following these tips, you can apply the knowledge from this chapter to make informed and effective investment decisions in practice. In conclusion, chapter A Century of Stock Market History provides valuable insights into the stock market over the past century, including the importance of a long-term perspective, diversification, and avoiding emotional decisions. I hope you found this video helpful. If you did, please don't forget to like, subscribe, and share it with your friends. We would love to hear your thoughts on this chapter, so please leave a comment below. Let's continue the conversation on investing and the stock market.